December 2025 arrives with a storm unlike anything markets have seen in years. Wall Street is celebrating record highs, but beneath the surface, the global economy is sending unmistakable warning signals. Inflation is rising again, job growth is stalling, and investors are quietly retreating into safe assets. Tonight, we cut through the noise and reveal what's really happening behind the world's most confusing economic moment. U.S. inflation is heating up once more. November CPI surged to 3.1%, the highest in half a year, while core inflation refuses to budge from 3%. This time, the culprit is clear: tariffs. The new wave of duties on China, Mexico, and Canada is pushing prices higher across the board. Everyday goods cost more, supply chains are tightening, and families are feeling the squeeze. The pressure is building, and it's not letting go. Shelter inflation is finally easing, but the relief is drowned out by rising goods prices. Energy markets remain unpredictable, logistics costs are creeping upward, and global shipping bottlenecks are reappearing. Economists warn that these forces could keep inflation elevated into early 2026. Real wages are disappearing in slow motion, and consumers are beginning to pull back. Confidence is slipping, one purchase at a time. The Federal Reserve sees it too, and they're not blinking. With inflation stuck above target, the Fed has quietly pushed the possibility of rate cuts far into 2026. Their message is clear: the economy must endure higher rates for longer. The consequences are everywhere: tighter credit, frozen mortgage markets, shrinking corporate borrowing, and a recovery that suddenly feels much further away than expected. The U.S. labor market, once the backbone of the recovery, is starting to fracture. November delivered just 118,000 new jobs, far below expectations. Unemployment has risen to 4.5%, the highest since 2021. Sectors from manufacturing to logistics are shedding workers, and job openings have collapsed back to pandemic-era levels. A slowdown that once seemed unlikely is now impossible to ignore. One warning sign stands out above the rest: the Sahm Rule recession indicator. It's now flashing red in 11 states, a signal that historically precedes broader economic contractions. While the nation hasn't slipped into recession yet, the early architecture is forming. Economists describe the moment as late-cycle air, thin and fragile. One more shock could tip the balance. Wages are rising, but hiring is collapsing. It's a rare and troubling combination. Paychecks are growing at 4.2% annually, but companies are slamming the brakes on new positions. Tighter immigration policies and disruptions from the government shutdown reduced available labor just as businesses began cutting back. Workers are earning more, but opportunities are fading. It's the paradox of a market losing strength. Corporate America is showing the strain. Outside the booming AI sector, corporate earnings are weakening. Margins are shrinking, costs are rising, and demand is softening across consumer goods, retail, manufacturing, and transportation. Executives warn that without lower borrowing costs and cooler inflation, profits will remain under pressure well into next year. Behind closed doors, boardrooms are preparing for a slower 2026. Yet in the middle of this slowdown, one force stands untouched: artificial intelligence. AI capital spending now accounts for nearly 1/3 of all U.S. economic growth. Data centers, cloud infrastructure, and semiconductor expansion are powering ahead like an unstoppable current. It's a rare bright spot, but also a risk. An economy leaning too heavily on a single sector becomes vulnerable to the smallest misstep. Despite all of this, Wall Street continues to roar. The S&P 500 and NASDAQ have climbed more than 22% this year, driven almost entirely by a handful of AI giants. Investors are betting on future productivity, future earnings, and future breakthroughs. It's a rally built on conviction and perhaps a little denial. Markets are celebrating while the real economy quietly stumbles. Look closer, and the cracks become clearer. More than 40% of all companies in the S&P 500 are down for the year, even as the index hits new all-time highs. The market is being carried by a small group of mega-cap winners, masking the weakness underneath. Analysts are blunt. This is classic late-cycle euphoria where headlines glitter but fundamentals fade. And while stocks rise, another story unfolds. Investors are rushing into the safety of U.S. Treasuries. The 10-year yield has fallen below 4%, signaling uncertainty, fear, or both. When stocks soar but yields fall, it often means smart money is preparing for turbulence ahead. The divergence is too wide and too strange and to ignore. The slowdown in the U.S. isn't staying in the U.S. Emerging markets are feeling the strain of a stronger dollar and weakening global demand. Europe's energy-sensitive industries are struggling, and key Asian economies report contraction in their manufacturing sectors. The world is watching the U.S. closely, because what happens next will ripple across every major economy. As 2026 approaches, forecasts are divided. Some believe a soft landing is still possible, a rare moment where inflation cools, growth stabilizes, and markets glide forward. Others see a different path: weakening labor markets, fragile consumer spending, and tightening credit forming the early outline of a mild recession. The truth will depend on the data, and the data is turning colder with each passing week. Markets are soaring, the economy is slowing, and risk is building beneath the surface. As investors celebrate new highs, the foundations beneath them are shifting. Stay alert, stay informed, and stay protected. This is World Finance News, bringing clarity to one of the most uncertain moments in the global economy.